US stocks and gold are trading around record highs, and the US dollar continues to struggle. Next week is a huge week for central banks. To talk us through what to watch, I'm joined by Head of Global Content, John Kicklighter. Thank you for joining us, John.
Thanks for having me.
So we're seeing stocks rise, trading around record levels, and up around 2% so far this month, defying seasonality. What general market conditions should we expect to deal with next week?
Yeah, the risk appetite drive continues untouched, and it's put into context, though. Yes, we are certainly at the cusp of a change in expected seasonality, but at the same time, the change usually happens right around this point of the year. So it's not that we are defying the seasonality at a more granular level, a week-to-week level. So what we really need to be thinking about, though, is the conviction in the risk appetite rise. So we have record highs for the likes of the S&P 500 or the Dow. But is this really charged with momentum that is fundamentally based? And that's the reason we say that is because once you assert yourself with liquidity or participation, open interest, whatever market you're in, then you are going to start to see the markets are more circumspect about the fundamental backdrop and whether they really want to take these risks of buying at new record highs. And the sentiment is really not that robust. We certainly have a building on risk on kind of mentality, but we don't necessarily have the really robust fundamental backdrop. So as we get into the 38th week of the year, which is this coming week, we do have a peak in volume to be expected. And there's also the consistency of risk aversion. Typically through the S&P 500, you calculate that over the past 100 years. And the 30th week of the year is actually the one where you actually have a second pullback in a series of three. Now, it doesn't have to abide by that, but the liquidity conditions will be there. And we have a lot of provocative themes that we will test the conviction. And I don't think it's going to stand up that well. Doesn't necessarily mean the markets have to fall into risk aversion just yet. But I think that eventually we're going to have a reckoning, especially with the low hedge approach that the markets are taking as they stretch these risk pushes, like you have for the VIX Volatility Index. Net speculative futures positioning is its most short in 4.5 years, meaning it's more of that pick the pennies up in front of the steamroller kind of mentality.
And what are the most potent themes that can upend the calm for the bulls or for the bears?
So thematically, I think we have to say principally it's going to be a monetary policy week. And in particular, we're going to have the FOMC, the Federal Open Market Committee. And there's a lot of reasons to be focusing on the central bank. It's the largest central bank in the world. Obviously, it generally is seen as the anchor for what the developed world is doing when it comes to monetary policy. But we're also at a potential tipping point of monetary policy for the Fed. Now, the expectations are for a rate cut, the first of this year, which would seem unusual considering so many of its peers have actually lowered rates, and some of them quite substantially. But the Fed has not moved this year. And this is probably going to be something of a late start. And the expectations are fully baked in. The question is, how much is actually priced? Is it more than what the Fed is willing to do? Is it less than what the Fed is expected to do? Or is it right in line? There's a very strong potential of a, we'll say, buy the rumor, sell the news kind of response here. But focusing on the Fed for monetary policy is a big theme. We also have to consider in the context of the general monetary policy and what it's actually rendering for the markets. You have not just the Fed. You have multiple central banks, including the Bank of Canada, you have the Bank of England, you have the Bank of Japan, and actually the Central Bank of China, all weighing in on monetary policy. And it's going to give us that context, especially after this past week, and the ECB would hold rates at the end of its cycle. Now the Fed is just starting its leg of easing. So it's this inconsistency that will give us some, especially in the FX market, some cross volatility. But you also have the context of what is monetary policy looking to achieve. And it's not just a stimulus factor, which a lot of, I think, risk-oriented traders or investors are looking at, but it's also in response to concern of economic activity and whether they are behind on trying to thwart that economic slowdown, which I think a lot of people would argue the Fed is, and they are arguing very aggressively. And that's why some, especially in the White House, are saying there's a risk, and that's why they have to do severe rate cuts. But this is also going to get us back to the core fundamentals of why monetary policy is being adjusted because of growth concerns. So it's going to be really monetary policy focused in the coming week. It's just how we look at it, and we can get very granular in particular markets, regions, assets, or we can look at a big picture and what it's doing to sentiment.
And turning our attention to the top event risk, what is the top event risk next week that could spur these themes or kick off a new focus?
Sure. So the first half of the week is going to be more data oriented. So we have, for example, on Monday, I would focus on the Chinese August data. So we're going to have house prices, industrial production, fixed direct investment, retail sales, and jobless numbers. Those are all very good overall perspective for the second largest economy in the world and its economic health. On Tuesday, we're going to get a range of data. You have the UK jobs, you have Eurozone sentiment, economic sentiment. And in the US, you're going to have housing market index, the NAHB housing market index, retail sales. So looking at the consumer, import, export inflation figures. So it's a broad mix. But these data points are probably going to be very secondary, maybe far secondary to what we're going to be looking at when it comes in on Wednesday. So we do have the Bank of Canada rate decision due on Wednesday, but really everybody's going to be focusing on what the FOMC does at the afternoon session in Washington, D.C. Now, the expectation is for a 25 basis point rate cut, but obviously there's a lot of speculation and a lot of opinions on where it should be going forward and whether they should do a 50 basis point cut now. Some even say more. That's going to draw all that inconsistency, some level of surprise from the market. And that's volatility. Surprise is volatility. But beyond just the actual change at this meeting, you're going to want to watch what they have for forecasting, because this is one of the quarterly events where they update their summary of economic projections. That includes interest rate forecasts, that includes growth, inflation, employment forecasts. These are all going to be very, very interesting. I would focus on those two things, and less so Jerome Powell's remarks half an hour later, because his press conference rarely goes off the line of trying to balance everything. He doesn't really achieve it with the markets, but it's probably going to be less market moving than the actual rate cut itself and the summary of economic projections. Then on Thursday, we have the Bank of England rate decision, and Friday we have the Chinese and Japanese central bank offering rate decisions. And those are very different. The Bank of England is very close to the Fed's benchmark rate. So if one cut from the Fed comes, then the Bank of England and the Fed are going to be right in line. Whereas on the other end of the spectrum, we have the very dovish PBoC and the BOJ. But the BOJ is actually has tightened this year. So we want to see how all these directions and these yield gaps are going to play out. And again, what does it mean for the specific region, but also what does it mean in the global context of risk appetite that monetary policy is coming, a short-term stimulus, but whether it's the stimulus that matters or the need for the stimulus that matters.
Well, plenty to be watching for next week. Thank you very much again for your time, John.
Thank you.
For more videos like this, please do like and subscribe.